Good morning, all. Got a pretty good group here. 1 week to the Super Bowl, and we're going to get into a chapter today that's a little bit tricky, certainly doable, and I'll do everything I can to make it interesting and relevant to you. So let's get going with chapter 3. Chapter 3. Okay, you should be able to see the slides now, and I have to make them my size. Okay, just need a snort here. Still have a ton of snow out there. Very dangerous walking around here. Okay, adjusting journal entries. Those of you who took 110 should remember this about the prepaid expenses and the accrued expenses and the unearned revenue and the accrued revenues. So let's take a look here. We are going to explain the importance of periodic reporting and then we'll get to the adjusting entries. All they're saying here is with this grid is that an accounting period doesn't have to be a year. And a fiscal year certainly does not mean January to December. You can have a fiscal year that begins in May, for example. One of the companies I own stock in is General Mills. They make cereal, and they grew out of the farm industry. So their fiscal year begins with the planting season and ends with harvest. Department stores like Nordstrom's, the higher end stores, their fiscal year ends at the end of January or February because they want to do the statements after a period where they were very busy for their year end shopping. So the accounting period can be any period of time. It can be a month, it can be 2 months, whatever. Accrual basis versus cash basis. We ignore cash basis in this course, as does every other accounting textbook in the world. Cash basis is not GAAP. If you are running your business on what's known as a cash basis, you'll never be able to borrow money, attract investors, and you're going to cash basis yourself out of business before you know it. That's for real tiny companies. Accrual basis, that's what we're teaching here. We're teaching accrual-based accounting, which means revenues are recorded when the products or services are delivered, and expenses are recorded when they're incurred. We don't care whether we paid for these expenses yet, nor do we care if we've been paid for the revenues. We send a truck out today. As soon as that truck leaves our store toward the customer, that's a sale today. Accrual basis versus cash basis. On the accrual basis, $100 of insurance expense is recognized in years 21, 22, 23. What they're saying here on the left is they bought a policy for $2,400. It covers them for the next 24 months. So on the accrual basis, we are calling that an asset. An asset, let me say it this way, insurance and supplies are an asset at the time of the purchase. It's in the future that we will record the expense. And I'm not going to go over the cash basis. The recognizing revenue. Now, you've heard me babble about this a few times already. Revenue recognition principle. Revenues recorded when the goods are provided or the service is rendered, okay? Ditto for recognizing expenses. Expenses are recognized and recorded when they're incurred. The month ended and you're looking at your trial balance and you notice you have no electricity expense. Well, you don't have the bill yet. And the bill is not going to come until the end of this month. You can't wait 3 weeks. You have to record a reasonable expense. The expense recognition requires that they're recorded in the same accounting period as the revenues that were generated during that time. It's the matching principle. The matching principle. That will definitely be on the test one way or the other. The matching principle. What do we match? We match revenues and expenses. Revenues and expenses. Okay, here we go now with something new to you who have not taken 110. We're getting into what are called adjusting journal entries. These are journal entries that can only be done at the end of the month. We worked last week with a trial balance, remember? We did a whole bunch of transactions and we came up with a trial balance. And we took all of those balances from that trial balance as the source for doing our income statements. What you're going to learn now is, by definition, that trial balance was wrong. It was incomplete because we haven't gotten up to adjusting entries. These are entries only can be done at month end. So we're going to determine what the current account balance should be and what the adjustment should be. And let me make this much more clear. We have two things: deferrals and accruals. Two types. Deferral. Defer means to do something later, right? We're going to defer studying until the night before the test. No, we're not going to do that. That's a bad example, right? Defer. What's deferred is the transaction. Money changed hands, but the sale was deferred or the expense was deferred. Accrued, no money at all, but we know something happened. And this hopefully will become clear as we go through these slides now. So we're going to talk about deferral of expenses. Deferral of expenses. We're talking now about prepaid expenses. Prepaid expenses are an asset. Can you believe that? So you can call them prepaid expenses or prepaid assets. You can call them either one. Probably easier to call them prepaid assets because, that'll remind you it's an asset. Prepaid assets are paid for in advance of getting the benefits. Insurance, rent is one, supplies, taxes, depending on your situation. There can be quite a few of them. And when you make these money outlays, you're going to debit an account, an asset called prepaid something, prepaid insurance, prepaid rent. It should say prepaid supplies, but our book reminds us that supplies is the asset and supplies expense is the account for the expense. So here we go. Adjustment for prepaid insurance. And this is a real good example here. You learn to do one prepaid, you've learned to do them all, okay? So here we go. Fast forward, paid $2,400 for an insurance policy to cover for 24 months beginning December 1st. They recorded the expenditure. Expenditure means the cash payment. They recorded it on December 1st. So this policy begins December 1, and it runs December 1, 2021, and it ends December 31, 2023. So that's 24 months. We're going to say to ourselves that $2,400 you see there is going to be divided. Let me just go back here quickly. We're going to divide that 2,400 by 24 months. So it's $100 of expense each month beginning in December. That's all there is to it. Insurance expense, we're going to debit it $100 to recognize the amount of the insurance coverage for December, and we're going to credit the asset prepaid account for 100, reducing the balance to $2,300. And let's take a look at it. We debited insurance, prepaid insurance. We debited that asset. We credited cash. We'll say we paid cash for it. Now, 1 month has gone by. That means we have to recognize 1 month of insurance expense, $100. We debit insurance expense and we credit insurance. Okay? What you're going to learn here is that most of the adjusting journal entries are a search for unrecorded expenses. Okay? Now, why did we wait until the end of the month to do this? Well, very simply, this could be a fairly big company and they may have multiple insurance policies. Some are lapsing this month, some are continuing, some are new. It would be very confusing to do this during the month. Much easier to wait to the end of the month and get your ducks in a row. Where I worked at Thomas and Betts, this is before we had personal computers. I had a spreadsheet going for prepaid insurance. And I had like 6 policies and I was lapsing them out every month to keep track of them. We debit $100 to the expense to recognize the amount of insurance coverage for that month, and we credit prepaid. The balance is now $2,300. Take a look. Not too tough. The prepaid asset is going to be credited and the expense is going to be debited. Most of your adjusting journal entries will be debits to an expense. So here we debit the insurance expense 100, we credit the prepaid to get that balance down to 2,300, and guess what? We're going to do that for the next 23 months until we completely use up that insurance policy. Hopefully we never need it. That's what we're hoping, but we are paying for the insurance just in case. So there is the prepaid insurance. The general ledger adjustment, and here I guess they're going to show us the general ledger and the journal entry. Maybe this is a better visual for some of you. What happened on December 1st? We debited prepaid. The policy began December 1st. 2,400 divided by 24 months is $100. We debit insurance expense and we credit the prepaid insurance to record the first month's expired insurance. My explanation could have been to record insurance expense. Make those explanations as simple as possible. Okay? If you know how to do prepaid insurance, you know how to do them all. But let's go to another one. Supplies. Now, here they mess with our heads just a little bit. Sometimes on the test and in your homework, they don't give you the expense. They give you the ending balance, and you must figure out the expense. So let's see what we have here. We have, fast forward, purchased $9,720 worth of supplies in December. And they used some of them in December. So we have a December expense. How do we get that expense? The answer is by knowing what we had at the end of the month. We took a physical count. We had all kinds of cleaning supplies and nuts and bolts and things like that we don't put in the inventory. We counted them up, and at the end of the month, we had 8,670. Well, that means that the expense is going to be $9,720 minus what was there at the end of the month. And what was there at the end of the month was the 8,670. Not too tough, right? We had 9720. We counted, and we have 8670. And that means that we used up that much of supplies expense. One other tip with adjusting journal entries: every adjusting journal entry has an income statement account and a balance sheet account. Just something that might help you a little bit. And I'm going to give you something else that really annoys me, okay? Don't annoy me. Cash. There is no such thing as an adjustment for cash. No adjusting journal entry should ever have the word cash in it as an account. And the reason I'm kind of teasing you a little bit is students get a little rattled, I think, on the test, and being unsure, they'll throw cash down there, thinking that might be what they're looking for. So you get the idea, I hope. We find the expense and we record it at month end. Now, obviously, it would be crazy to record the supplies expense every month. What are we going to do? Count the number of light bulbs somebody used in a particular day? No, you do it at month end. Balance sheet is going to show that balance of 8,670, and the income statement has the 1,050 of supplies expensed. Exclamation point, huh? Very, very happy author here. We've seen the adjustment in the T accounts. Let's look at the general journal and the general ledger. There is our journal entry. We debit supplies expense and we credit supplies. Okay. There is a third deferral. Now, these are the deferreds. Why do we call them deferred? Because cash changed hands, but nobody's done anything yet. So the person who paid the cash has not incurred an expense yet because the benefits are coming in the future. The person who received the cash has no revenue because they haven't as yet provided their service. So let's introduce the third deferral, okay? Depreciation. Instead of expensing the cost of a plant asset, like equipment, building, cars, big machinery, instead of expensing in the year it's purchased, we allocate or spread out the cost over the expected useful life. Useful life is a GAAP accounting term. When a company buys a big fixed asset, they're allowed to depreciate it or allocate it or split, meaning split it up month by month. Companies love depreciation expense because there's no cash involved. You're recognizing theoretically the lower value of the asset as time goes on. So in this course, we're going to learn 3 or 4 different depreciation methods. In fact, in about 2 or 3 more chapters, we have an entire chapter devoted to fixed assets, how to depreciate them, dispose of them, etc. So depreciation expense. Instead of expensing the cost in the year it's purchased, we allocate it over the useful life. And keep aware of this. We take the cost of the asset, which might have been $66,000, and if there's any salvage value, we take that out. You can never, ever depreciate below the salvage value. By salvage value, the junk value. We bought a machine for $100,000. We bought this big fancy SUV car for a saleswoman, and her territory takes her from Seattle, Washington to San Diego. And in just 3 years, she beat the heck out of this car. It's got 300,000 miles on it. Everything is shot. We think a junkyard will give us $2,000 for the parts. That's an example of salvage value. You don't depreciate that. So let's look at our first depreciation adjusting journal entry. And you should pray they put a few of these on the test, because the debit and credit is always the same and not used elsewhere. And you'll see that in a moment. They bought equipment for $26,000, a useful life of 5 years. The equipment is expected to be worth $8,000 at the end of 5 years. That's the salvage value, which we do not depreciate. So we're going to depreciate $18,000, 26 minus the 8. They bought the equipment December 1. Now it's the end of the month. How do we do it? Because Fast Forward expects the equipment to be worth $8,000 when the 5 years are over, only $18,000 will be depreciated. 18 divided by 60 months or 5 years. And here it is. The original cost, 26, subtract the salvage value, the net cost, 18. We're now going to divide 18,000 by 60, the months. It has a useful life of 5 years. The equipment is expected to be worth 8,000, etc. Been over this, okay? The useful life. The term useful life is a gap term. It must be a reasonable amount of time that you're depreciating it. You can't buy a $5 million machine and see that you had a profit of $5 million and go to the accounting people, hey, Julie, do me a favor, will you? We're going to depreciate this entire machine in 1 year. No, you can't do that. It has to be a reasonable amount. Companies would love to do that, to reduce their taxable income to zero without a penny being spent. Can't do that. So here we go. Adjusting for depreciation. Depreciation adjustment looks like this. Notice we debit depreciation expense. Okay, that's what it's called. Depreciation expense. It might say depreciation expense dash truck or something. Okay, and excuse me, please. Oh, yeah. We debit depreciation expense, but we don't credit the asset. We credit an account called accumulated depreciation. Every depreciation entry is a debit to depreciation expense and a credit to accumulated depreciation. Accumulated depreciation is what's called a contra account. A contra account, meaning in this case, that is an asset, but it has a normal credit balance, okay? It's a contra from the Spanish word meaning contra, okay? Against, it goes against the grain. You never credit the original cost of the equipment unless you're selling it or getting rid of it. That 26,000 there, you're never going to touch this account again as long as you are keeping that equipment. What you are going to reduce is what's called the net book value. 26,000 minus 3 at the end of December would be 25,700. That's called the net book value. So we record the adjusting entry for 1 month, debit the expense, credit the accumulated depreciation. And in this course, you'll find some more contra accounts, and you'll be working with those as well. And here's how it looks. Equipment, you don't touch it. Remember, you debit the expense and you credit the accumulated depreciation. And here's the journal entry. You like to see that visual? Debit expense, depreciation, credit, accumulated depreciation. Now, I'm very happy they put this here. Here, they're doing it after 3 months, I think, whatever. The original cost, if you remember, was 26,000. And at this point, they have $900. So this is after 3 months. The equipment is going to show just like this on your balance sheet, 26,000. It's always going to be 26,000. It can never be anything else 26,000, okay? What's going to change is what's called the net book value. They're calling it net equipment here. The proper term is net book value, 25.7. And that's exactly how it's presented in every balance sheet in the world, okay? After 3 months they're explaining this thing now. After 3 months, the book value is down to 25.1. It went from 26 to 25.7, 25.4, and then 25.1. Excuse me, net book value. Okay, we just went through one of the deferred categories. And remember, we said that with the deferral, money changed hands, but nobody did anything, like with the prepaid insurance and the prepaid supplies. Now let's prepare the adjusting entry for the deferral of revenues. And we went over this briefly in the prior chapter. A prepaid asset is the same thing as unearned revenue, depending what side of the transaction you are. We bought insurance from State Farm. We debited cash, or we debited the asset called prepaid insurance, and we credited cash, but we didn't show any expense yet. On the other hand, State Farm got our money. They were happy to get it. They debited cash, but they have not given us any insurance yet. So they credit the liability account, which you remember called unearned revenue. Unearned revenue is cash received in advance of providing products or services. So we got the money. That's great. We debit cash, but we have to credit the liability account called unearned revenue. And let's take a peek. I don't like this grid the way they set this up here. And we'll take a peek at it. What they're saying here, the journal entry is it's going to be a debit to the liability account and a credit to revenue. Insurance revenue. State Farm, they could say we can now recognize $100 of income we did earn and reduce the unearned by 100. Fast forward, client paid a 60-day fee in advance, covering the period from the 27th to the 24th. And that's exactly 60 days. Fast forward earns payment as time passes. Well, at the end of the year, 5 days has been earned. December 27, 28, 29, 30, 31. 5 days. It comes out to be $50 a day or $250. 5 days is earned. They're telling you that it was 3,000 divided by 60 is $50, right? 3,000 divided by 60, $50 a day times the 5 days they earn the revenue. So they will debit the unearned revenue and credit the revenue, the actual revenue. Here, they're backing up to show the journal entry when we received the money. We got, you paid me, my insurance company, this cash. That's my entry to record it. And let's take a look. We had $3,000 paid to us in advance. We debited cash and we credited the revenue for $3,000. And now, during the month, we had these other consulting fees that have nothing to do with this. But we did earn $250 out of here. We reduced the asset to bring it down to $2,750, and we layer in the revenue of $2,050, and that gives us a total revenue of 6050. Okay. Adjusting entry, unearned revenue. That's all they give us, huh? They're showing you the journal entry. You debit the liability account called unearned, and you credit revenue. So if you keep in mind that a prepaid event is also an unearned revenue event, depending on what ox is being gored. I bought the insurance, I credited cash, and I recognize an asset that I've not used yet. You received my money, you debit the cash, and you recognize that you owe me $3,000 or whatever it was worth of insurance. Okay. So those are called the deferred expenses. Now I'm going to go off track a little bit. Um, I've been spending a lot of time going over the summaries in more detail than I normally would. I've only got this one class right now. When I get done with you guys in 8 weeks, then I've got like 3 or 4 classes. So I'm spending a lot of time on them. On those summaries, I love to see little templates, little sketches. And here I would expect to see you maybe write out one of these journal entries and put a couple numbers in them to support your narration. The summaries I'm getting are actually quite good for the most part. And I encourage those of you who are doing them, you're doing yourself a great favor because doing those summaries is a predictor of success. Okay. Okay. So we went through the deferrals. Let's look at the accruals. Accrual. An accrued expense is a cost incurred in a period that's both unpaid and unrecognized. Ooh. The electric bill, my favorite example. The month ends and you haven't recorded any electricity. How could you? You haven't got the bill yet. Well, we have to figure out a number though. And in Southern California, it's pretty easy because the weather's pretty temperate, right? The heating bill doesn't change that much. It's been running about 1100, 1150, 1110. We'll accrue 1175 just to pick a reasonable number. So you debit an expense and credit a liability, and that liability should begin with the word accrued, by the way. Okay, now here's an example I think you people will pick up right away. I assume that you guys who've worked before, you're out in the workforce, huh? Working men and women, salt of the earth, adjusting for accrued salaries. Fast Forward pays its employee, I guess they have one, $70 a day, $350 for a 5-day week, and they're paid every 2 weeks on a Friday. So far, not too hard. December 31st is a Wednesday. So 3-day salaries are owed at year end, which equals that $70. You know that on the 31st, you're not going to get that, you're not going to get paid that day. In fact, it says here you're not going to get paid for 2 weeks. You might not get paid till January 10th or something. But you did work 3 days during the month of December, we'll say. December, 3 days. That is an expense that the company must recognize. An adjusting entry always increases a liability, salaries payable, and increases salaries expense for $210. Okay, so let's take a peek here. $210. You did work on the 20, whatever it was. What was the date? Anyway, 3 days. You worked 3 days in December. That's where that expense goes. We don't care when you're going to get paid, but legally, the company does owe it to you at the end of the 31st. Legally, they do. If you resigned on that day, they'd have to pay you right then and there. If they fired you, they would have to pay you right away, or if they went out of business for whatever reason, you would be entitled to a payment. But when you joined the company, they told you our policy is we hold back 2 weeks' pay. And you said, I'm fine with that, like all other employees. Let's take a look here. That up, huh? Okay. Where were we? We're talking about accrued salaries. You work in December, that's the expense. You debit salaries expense and you credit the payable. Okay. So the income statement is now going to show 1,600 because you had 1,400 to begin with for the last 4 weeks. Let's keep going here. Future cash payment of accrued expenses. Accrued expenses at the end of one period result in a cash payment in a future period. Okay. On December 31st, fast forward, recorded accrued salaries of 210. That's what we just did. Now, on the 9th was payday. The following Friday or whatever is payday. The following entry is to reduce the accrued liability, record the sales payable, and record the expense for 7 days of work in January. So, wow, we're looking at a 3-line journal entry. So let's think about it. Let's divide and conquer. How much is the payroll each week? $700 for 10 days, rather, $700. Remember, we already accrued 3 days of expenses in December. So that payable is sitting out there. So when we record the $700 payment, we're debiting 210 to reduce the expenses in the payable that we already recorded, and we debit salaries expense for 490. So that $700 has been properly split between 2 months, 210 in December and 490 in January. Okay. Let's look at one other one, accrued revenues. And remember, accrued means no money involved, but something's happened. Accrued revenues are revenues earned in a period that are both unrecorded, not yet received. What's an example of an accrued revenue? Interest is a good one. We loaned money to somebody. They don't have to pay us back for 10 years. It's a bond, say. We loan somebody $1 million. They don't pay us back for 10 years, but they have to pay $50,000 a year in interest. And that interest is accrued every month, whatever the number is. And at the end of the year, we're going to show expense of, we're going to show a receivable of 50,000 and a credit of 50,000 to income. Okay. Adjusting for accrued services. This customer agreed to pay $2,700 on 110, and then on the 31st, he provides the. Let me look at this. On 12/31, 20 days worth of services have been rendered, so we're going to have an adjustment of 1,800. We're going to debit accounts receivable and credit consulting revenue. What I don't like about this slide is that this is really a basic accounts receivable transaction that we learned in chapter 2. They just make it a little more complicated. And here it is. We debit account 1,800. We credit the interest or the consulting revenue, whatever it might be. Balance sheet's going to show that 1,800. And now we have a layer on top of our earlier recorded revenue. Future cash receipt of accrued revenues. Accrued revenue at the end of one period sets up a receivable to be paid in the following period, just like we did with the accrued payable earlier. We recorded salaries payable of 210, which meant in the next month we're going to debit that, and the balance would be the expense. Here it's income. So we have accrued revenue earned of 1,800. On 110 of next year, the following entry will be recorded. Now take a look. The total cash payment is $2,700. That was the deal, that we were going to do $2,700 worth of work for these people. We accrued 1/3 of it last month. Remember, we debited the accounts receivable, and we credited the consulting revenue. Now, when we record the cash payment, cash receipt, we're on the good side now. The cash receipt is 2,700. The balance is 1,800 still in AR that needs to come off. Look over these couple entries here. Get in your mind that when we accrue something, it means that there's going to be an opposite coming the next month. Okay. Now, I'm always talking about templates. This might be a quick one to do. A quick one. I wouldn't worry about the whole thing here, but the deferrals. It says paid or received cash, accruals, paid after expense, deferrals, paid before expense, and maybe just plot this out. I do recommend you draw these little pictures that I call templates on your summary. Now, let's look at our new financial statement using the adjusted trial balance. Whoa, look at this. We're going to have a worksheet. Well, we already know what a trial balance is, remember? Trial balance, that's just a list of all the accounts in order of assets, liabilities, equity, revenue, expenses. Now we have the trial balance, and here on this worksheet, we have to post our journal entries, post or copy, whatever you want to call them. Now, we said that most of your journal entries are a hunt for unrecorded expenses. So let's see the expense side first. Here we go. We have depreciation expense, salaries expense, insurance, and supplies. Okay. Well, what are the offsets? Depreciation expense is going to be 300. There's our 210 in salaries payable. Here is the 100 in prepaid insurance coming down, and the 1050 in supplies. We had that AR entry of 1,800, which I don't think is an adjusting entry, but okay, 1,800, credit the revenue. So our trial balance had these balances. Now we have to get the new adjusted trial balance. Well, you never adjust cash, but you need to go down every line. Accounts receivable went from 0 to 1,800, so the balance is 1,800. Look at the supplies. We had 9,720, and then we counted 8,670. Remember, at the end of the month, that gives us the reduction in prepaid insurance and the debit to the expense. Same thing with the I'm sorry, guys, I'm pushing this thing too much. Same thing with the accumulated depreciation. We credited 300, which means we now have a balance of 300 because it was a new company. Typically, you'd have a balance in the adjusted and you just add them together. So we do this for everything. We had no depreciation expense. Now we have 300. So that's our balance. We did record $1,400 worth of salaries, but then we accrued 210 more, and you get the idea. You have no balance here. You have a debit here, so the balance is a debit. So this is called the adjusted trial balance, the adjusting trial balance. Now they go through these steps. We're not going to kill ourselves with this word for word, but how do we do it? You prepare the income statement using revenue expense accounts from the adjusted trial balance. And then when you have the income statement, you can prepare the statement of retained earnings using what you pulled from the income statement and the dividends. You prepare the balance sheet again from the trial balance, the adjusted trial balance. So let's take a peek. A peek. Here you see the adjusted trial balance. This is blessed now. This is good. This is what we're going to use to prepare the financials. You have debits, balances in cash, receivable, etc. So we know what the trial balance is. Now we're ready to do our financial statements. Can I give you a hint? Go to your first revenue line, wherever it is. Your first revenue line is consulting. Everything above that consulting line is your balance sheet. Everything listed above the consulting revenue is going to go on your balance sheet. I am never going to give you a problem with an out of sequenced balance sheet. You can count on that. Now there might be a problem in your homework where they do, and then you're asked to straighten it out. That's a different fish. But I'm not going to give you a botched up trial balance and expect you to clean it up. Everything starting with that first revenue is your income statement. So let's take a peek. I say the income statement begins with the 7850 and the 300 revenues, everything to the left of that below, your expenses. And here it is. Fast forward company income statement for the month ended, or month ended, or month ending, whatever. Month ended, because these are cumulative numbers. There's our revenue, there's our expenses, and there is our net income. So this company made a very healthy, almost 50% on their sales. Pretty darn good. Now we need to do the next statement, which is the statement of retained earnings. And the first thing we need to know is what the beginning retained earnings balance was. And we know it's zero because this is a new company. We also need to know if they paid any dividends. And guess what? They did. $200. We see that right here. So here is now our statement of retained earnings. Zero to begin with. Add net income, which we got right from here. Subtract the dividends. Dividends is the opposite of an investment. It's giving away part of the company. And now that we have the final retained earnings number, we can put it right into our balance sheet, and we pick up all these other numbers directly from the trial balance. 4275, 1800, etc. There it is. The adjusted trial balance. Let's talk about closing entries, okay? Closing entries. The closing entries are done to zero out all revenues and expenses and transfer them to your equity section via retained earnings. Okay. At the end of the month, you had $6,000 of electricity expense, and you had $2,000 of salaries, and you had $1,000 of advertising. At the end of the month, they have to be zeroed out. You don't carry an expense balance month to month because your expenses, as we just learned here, get moved into equity. Let's take a peek. It's done through the retained earnings statement. So let's identify what we're talking about here. We are going to reset the revenue, expenses, and dividends to zero. Whatever those numbers are, we bring over to retained earnings and come up with the new balance. So identify the accounts that we close, record the closing and new trial balance. We have temporary accounts and permanent accounts. Easy, man. Temporary accounts we close. Temporary accounts we close. And what are the temporary accounts? Income statement. Can you remember that? The temporary accounts that we close are the income statement. Also the dividends. Temporary accounts. Don't even worry about the permanent accounts, which is your balance sheet. Remember, the balance sheet is a snapshot in time. At the end of the month, this cash asset equaled $1 million. And if we got another million tomorrow, we have 2 million. The expenses don't work that way. We zero them out. And this slide here is really all you need to learn right here. 4 easy steps. Close the credit balances in the revenue accounts to an account here called income summary. That's a new account. How do we close a credit balance? By debiting it. Close debit balances to income summary with a credit. At that point, your income summary will equal your net income. And then you just add, in this case, subtract the dividends to retained earnings. Here's a good visual right here. What are the temporary accounts? We decided it was all the revenues and all the expenses. So we had revenue was $78.50. How do we get it to zero? How do we get this $300 in rent revenue to zero? By debiting the balance. We debit consulting revenue for $78.50, rent revenue $3. That's $81.50 credit. At that point, the income summary equals our sales. We do the same thing with all of the expenses. Expenses have a normal debit balance, so we are now crediting, get them all down to zero. They happen to add up to $43.65, which means the new balance is $37.85, which happens to be the net income. And now we zero out the income summary with a debit, and that credit comes over here to increase retained earnings, and we get rid of the dividends. That's also closed, okay? So your 4 steps are right here. I would think you'd write this template right here. Just copy this thing. Close income statement, credit balances, close income statement, debit balances, close the income summary, which will then be your net income, and then get rid of those dividends, okay? Once we've done that, we will now prepare another trial balance. Oh my goodness. This one's called the post-closing trial balance. It's done after we've prepared the closing journal entries. Just excuse me for a second. Post-closing trial balance done after the closing entries. What you see here is a trial balance that has no income statement items on them, right? How come we don't see sales, and how come we don't see expenses or dividends? Because we close them. So at this point in time, at the end of the month, our post-closing trial balance includes only assets, liabilities, and equity. And on the test, they love to throw a question down where they'll say, which of the following items is not on the post-closing trial balance? And they'll say equipment, common stock, accounts receivable, or utilities expense. And you know, utilities expense would be the answer. Just going to look at this briefly, but I hope you find it interesting. we've covered quite a lot, whether you realize it or not. We've gone through the entire accounting cycle. Whether you're a big company like Microsoft or a small company or just a small sole proprietorship, a store on State Street, perhaps, look at the cycle. We learned that we have to analyze a transaction. We did that in chapter 1. Then we learned about journal entries, the mechanism to record the transaction. We then review our journal entries and post them to the general ledger. And once we have that, we can prepare an unadjusted trial balance. In this chapter, we learned about the adjusting entries, and we learned that we're going to have this, at this point, 6-column worksheet. And from that, we do our financial statements. We close the income statement. And here we go, our post-closing trial balance. So we went through the whole cycle. Just a little more, and we'll get you guys out of here. I know this is a pretty long chapter here. Classified balance sheet. Huh? All we're doing here is introducing categories on the balance sheet. We're going to take our assets and determine how much of those are current assets or non-current. A current asset, 1 year. Current assets are expected to become due within the longer of 1 year or the normal operating cycle. Just remember 1 year, okay? 1 year. We bought something from somebody on credit. We have 30 days to pay. That's a current liability. Current asset would be cash, accounts receivable, inventory, prepaids. Current, you're going to be using them up. We're going to have non-current assets and non-current liabilities. And I'm going a little bit ahead of myself. Under non-current assets, you're going to have long-term investments. Maybe you loan money to somebody and you're carrying a big bond where you bought some stock. Plan assets, it's fixed assets, the big guys we depreciate, and intangibles. We have a whole section on intangible assets. You can't see them, you can't feel them, but they're there. Intellectual property is what we're talking about. Patents, trademarks, franchise fees, things like that, copyrights, and then non-current liabilities and equity. Okay? And take a look at it now. Now our balance sheet is a little more inclusive, don't you think? We have assets, and the current assets total 42. The current liabilities get up to 29. So anybody looking at this balance sheet on a real quick basis, the first thing they can see is that we've got pretty good coverage of our current liabilities. We have a ratio that might look pretty good. And then they're looking at the long-term investments. We have a note receivable. We loan money to somebody. They're paying back in 3 years. Long-term liabilities. It could be a note. It could be something else. Here's our fixed assets, plan assets, intangibles. That's all the classified balance sheet is. It gives you these subtotals. Current assets, 1 year cash, short-term investments, accounts receivable, short-term notes, inventory prepaid. For purposes of this class, we're mostly talking cash, receivables, inventory, and prepaids, okay? Long-term investments, notes receivable, and investments in stocks and bonds expected to be held for a while. Those are considered long-term. Plant assets, those are the big ticket items that we depreciate. Your book loves to call them plant assets. In my world, they're always called fixed assets. And I think the book does use that a little bit. Oh, there it is. Fixed assets, also called PP&E, property, plant, and equipment. Intangible assets, patent, trademark, copyrights, goodwill. Oh, we're going to get into goodwill later on. Current liabilities, 1 year. Long term would be longer. A mortgage is a classic, right? Long term liability, maybe a lease obligation. Equity is the owner's claim on the asset. It's what the business is worth on paper at that point in time. And the equity is reported in retained earnings and the common stock accounts, among others. And there's no such thing as current and non-current equity. And now we're getting toward the end. Now, again, on your summaries, I would like you to write this down and tell and describe it for me. Compute the profit margin and current ratio. Well, let's take a peek. This is Visa and MasterCard. Your profit margin. I would bet that's the first thing an investor looks at. Are you making money? Huh? Are you making money? And we look at Visa for the current year. Their income, we'll start with the sales. Their sales were almost 23 million, and they had income of 12 million. And let me remind you that this is in billions, not millions. You have to add 6 zeros to these numbers, believe it or not. So they had net income of 12 billion on sales of 23 billion. That's fantastic. That's almost 50%. That's unbelievable to me. MasterCard, theirs was a little lower, 48%. But look at this, 53, 50. I don't know what happened here. It was only 36%. I bet that was the pandemic year, right? Net income divided by net sales. Everyone wants to know that, okay? Here's another one they look at. The current ratio. So important. It assesses a company's ability to pay its debts right now if they chose to do it, meaning their current debts. And we're simply going to take the current assets and divide it by the current liabilities. So if we look at Costco, their current assets are 23.5 and the current liabilities are 23.2. So their ratio is only 1.01. But guess what? Costco knows what it's doing. Anyone who does big business with Costco knows how they squeeze every nickel out of you, every penny. You say you can sell it to them for 48 cents, they want it for 46. And you say, well, I can't go any lower than 47. Then they say, okay. My point is they know how to run on these lean margins. Normally, you want to see more than one. You want to see two, maybe even 2.5. Walmart is even worse. Technically, Walmart's out of business. If you look at this, this means they don't have enough money right now to pay off all their current liabilities. But do you think Walmart is worried about that? No. They are generating cash flow like crazy, and they're using it to buy things and beef up their inventories. So, current ratio. And now we finally finished with the chapter, huh? Hey, you three guys hung in there with me. Is everybody awake? You there, Daniel? Maybe not.
Yeah, I'm still here.
All right, we didn't catch you sleeping there, huh? What do you think of this class so far, Daniel? You love it, right?
Yeah, it's solid. It's all right. It's a lot of
Okay,
work, but it's solid.
yeah. And who's this? Shamitra, how you doing? Good to see you again.
I am well, and you?
Good. You following along?
Yes.
Okay. You keep up with the good work. I think you guys all had good summaries, if I'm not mistaken. Hey, Brayden, are you the Super Bowl guy?
No, I'm not. Sorry.
Not really. You're not going to waste all your time next Sunday, then, huh? Okay. Hey, I'll let you guys go. Thanks for popping in, and we'll see you later. Okay. Bye bye.
No, have a good day.
You too.